Hello, welcome to chapter 1. We will start with the basics on some introductory concepts on why is risk management important and how we're going to apply it in different companies. So let's first take a quick look at what is economic value creation and why is it important in this topic of risk management. In a very basic sense and in a very condensed graph, we can analyze any company as having a cost of capital, the WACC, the weighted average cost of capital, which is basically the cost of money. All companies need money to operate, and that money is not free. It has a cost. So that cost is the WACC, and it can be seen in this analogy of a high jump. Let's say that in a high jump, the WACC is the bar, the reference bar, and a company will obtain a ROIC, which is the return on invested capital. Of course, you want this ROIC to be higher than the WACC so you can, let's say, set a record or be above the bar. And this is in a very simple way, the idea of economic value creation. To do this value creation, let's take a look at this other graph. Any company has a set of assets, buildings, offices, vehicles, whatever. And these assets, of course, cost money. They had to be financed by either debt or equity. So these assets are being put together so they can produce cash flows. This we will call free cash flow to the firm, is the basis of the value creation. Any company can be valued either as a whole or as an investment project that you want to take on. The metric that is usually estimated is the free cash flow to the firm. If you use the free cash flow to the firm, you should discount this at WACC. So the idea of this graph is showing that the value of any company will be produced by the cash flows that is able to do in the future with those assets. Now, these assets, of course, have to be managed efficiently by humans, us, managers, CEOs, and so on, so that the going concern value of any company is higher than the liquidation or the asset value. Otherwise, it wouldn't make sense to have such expensive assets, and being that the case that the cash flow that they produce actually is worth less than the value of those assets. In this case, it doesn't make much sense to be running that company. So in the other case, in which you actually manage to add value from the managers, from the people, from the human capital that you apply to these assets, since you're experts, you are the managers of these companies, you will be able to have this future money worth more today than those assets. That's the basic idea of value creation. Again, that the going concern value is higher than the asset or liquidation value. Now, to be able to do that, you will have different sources of capital as you take on new positive net present value project. It has been shown in the literature, both theoretical and empirical, that there is a capital pecking order. That means companies usually go from the least to the most desirable source of capital in this way, being the least desirable equity, issuing equity, then issuing debt, and the number one or the preferred source of funds is usually your internally generated funds. So now, if you need those internally generated funds to be able to create economic value, as we saw on the previous slides, you want to do, or you want to be able to insulate or protect those funds from factors that are out of your control. So you have funds that you're able to invest in positive net present value projects. As a company, you will have different risks. For example, let's take a look at a few of them. You have the risk of bad quality, of fraud, of poor sales, and so on. You have different risks, And in this case, you have some mitigation actions that you could do to eliminate or reduce this risk. For example, that quality you can reduce by training your personnel, having good materials, and so on. If you have theft or fraud in your company, you can have better controls, cross checks, auditing, and so on. So if you take a look at all of these, in some way, these are in your control. You can, as a manager, you can do all of these actions to reduce or mitigate these risks. So in other words, they are under your control in some sense. Now, there are some risks that you may be the best manager around, but even so, there are some risks that you cannot control. For example, the currency exchanges rates, the interest rates, and the commodity prices. These are the typical risks that affect most companies worldwide, and there is not much you can do about this. Again, referring to your managerial abilities. These are based on international prices, on international market movements. So again, you may be the best manager around, but these risks are out of your control. So what we will do in this course and in this book is learning how we can manage these risks. So we will focus many of our examples and applications on how to hedge these unwanted risks. So now let's take a look at the derivatives and the types of investors that we will find in these markets. So let's go to the basic definition of a derivative, which is a financial instrument that offers some return and is based on an underlying asset. That's where its name comes from. It derives its value from another asset. And of course, its performance is tightly referenced to that underlying asset. And once you understand all the mechanics of derivatives, there's actually no limits on how many applications you can do and how many investment objectives you can deal with under this definition. So the underlying can be any interest rate products. You can have indices, equities without dividends, with dividends, and so on. You can have currencies, and you can have many types of commodities, and even some weather metrics such as rainfall and snowfall and so on. So we will analyze basically four derivatives, which is forwards and swaps on the private markets and futures and options on the public markets. We will also take a look at different motivations of investors. You can be a hedger, in which case your objective is to fix the price. You can speculate on the market movements, which means that you will take a bet, basically. That's what you are doing, taking a bet on the market movements. And you can either, of course, have a profit or loss on that position. And we will analyze an arbitrager, which is someone that observes an abnormal condition in the market and will take advantage of that. Let's take a look now at the basic mechanics on how forward commitment works. So let's analyze a spot versus a futures transaction. In a spot transaction, you will buy the asset today. So that's a spot transaction is usually defined as a transaction that is settled within 2 or 3 business days. And for some reason, you will probably need this asset in the future, but you will buy it today. So in this case, as you acquire the asset today, you will be exposed to the price variation on that asset. That's what is called a naked position. If that's the case, you may incur in storage and financial cost of having bought that asset today. On the other hand, if that asset produces any benefits or cash inflows, you will of course receive that because you're the owner of the asset. Now, if instead of purchasing the asset in a spot transaction, you decide to do a contract in which you commit to either buy or sell that asset in the future, in that case, you will receive or deliver that asset in the future, but you will commit to it today. So in this case, you will fix the price today, but the transaction will be settled in the future. There's no price risk since you will fix the price on day zero. If you're buying the asset, you will not need to incur in any storage cost because you won't have it until later. And on the other hand, if you don't own the asset yet, you will not receive any benefits or cash flows that the asset produces from day zero until the time that you actually receive it. So what's the basic idea on a forward commitment? Again, is today you have to specify and agree on 3 metrics: the price, the asset, and the time that it will be delivered. So on day zero, there's a contract that specifies these 3 items: price, what's the asset, and when is the contract expiring, and what happens at expiration. At expiration, you either have side 1 or side 2, depending on which was your position on day zero. So if you take side 1, in which you deliver the asset and receive the payment at expiration, that's a short position. And similarly, if you take a long position, that will mean that you will receive the asset and deliver the payment. In a very simple analogy, it's like when you order pizza and you're at home and you order pizza. So you call the pizza company. At the time that you call them, you agree on a price on such pizza, let's say combo number 3, and you will get that in 30 minutes. So at the time of the call, you set up this, but there's not a money interchange until the pizza guy comes to your door. Then you will have this interchange. So the pizza guy will be the short position in this case. He will deliver the pizza and receive the money. And you at home will be the long position because you will receive the pizza and deliver the payment. That's a very simple analogy. What makes us go into a forward commitment? Basically, most future events are subject to uncertainty. We don't know exactly what will happen in the future. So these sentiments could be positive or negative, could be a hope, a belief of something good, or could be a worry or expectation, a fear that something bad may happen. So it could be either way, a positive or a negative sentiment, but it's something that you think could happen. You're not certain. It's just something that you think it may happen, exactly the same way when you take insurance on your car. If you take insurance of your car, it means that you have the belief or the expectation that something may happen to you, your car, or a third party. So you take insurance just in case to prevent any issues with that. So what's hedging? Hedging, it's taking a position in which you will protect or insure your asset, your underlying asset. However, it's important to see that there is no guarantee that actually the economic outcome will be better. Actually, it could be worse. So let's take an example on this. Let's say you have agricultural products, carrots, pineapples, whatever, wheat, whatever. So you're having your fruits and vegetables today, and they will be ready to harvest in a year or 6 months or whatever in the future. However, you don't know, of course, you have no idea what the international price will be of those items in the future, of those commodities. So let's say that you want to sleep well and not be worried about the future international price. So today you fix the price at 100. So it means that today you enter into a contract, and at time T, at the expiration, you will get 100. It doesn't matter what the price is at that time, you will get 100. So let's assume that at time t, the international price of your commodity is 80. So you will receive 100, even though the market price is 80. So if you took that decision in your company, you may be seen as a hero, right? Because you are so good at foreseeing the future, and you actually receive more than the international price of that asset. However, if at time t, the international price of that commodity happens to be 120, regardless of this, you still will get 100. So in that case, you may be seen as a villain, right? So that's a very common situation in derivatives. If you're hedging, you will have to forget about any profit and loss per se, because your purpose is to hedge, not to speculate. You cannot do both things at once. So this is a very common happening in many companies, in which if things go well, in the sense that the derivative insure you and pay you, that looks good. But if the opposite occurs, you may be seen as a gambler or a speculator, and that's important to have in mind, because hedging is not worried about a profit or a loss. Is actually your focus is on exactly that, just ensuring and hedging your position. So another important difference in the derivatives markets and positions is to distinguish between motivation and the instrument. The motivation is actually what drives you into using the derivative. It could be to hedge, to speculate, or to do arbitrage. And the instrument is what you're using to achieve your objectives, which are, in this case, forward, future, swaps, and options. So the motivation, in some sense, is what drives you into the contract, and the instrument is what you're using to achieve your objective. In this simple analogy, the bench press is the instrument, and how you use it, or what's your purpose of using it, is inside of you. So you may use these derivatives to achieve these objectives, and these are not necessarily obvious. Someone can be in the market trading futures, and you do not necessarily know if they are hedging or speculating. So that's the idea of this analogy, to show that the motivation is one thing, but the instrument, it's a different one. Now let's analyze the long or short positions, in which if you take a long position based on your motivation or your expectation of future events, that means that you're buying at the expiration, you will receive that underlying asset, and you will, of course, pay a price. That's why you are taking a buying position. If you're taking a short position, which is the opposite, it means that you will deliver, you are committed to deliver the underlying asset, and of course you will receive a price for that. So these are the two typical positions in these forward commitments that we're starting to analyze now. Now, you will take a long or a short position depending on your expectations of the future. If at contract inception, you believe that the prices will go up in the future, you will take a long position. Otherwise, it would not make sense to fix the price. If you want to buy something and you think that the price will go down, there's no sense in fixing the price. Similarly, if you are taking a short position on a future commitment, it means that your belief is that the price of the underlying asset will go down. Otherwise, it wouldn't make any sense to fix the price today. So if at contract inception you take a long position, that means that somehow your expectation is that the underlying asset will go up in price in the future. If you're taking a short position, the only way it makes sense around that is that if you think that the underlying asset will go down in price in the future. Okay, now let's take a look at the motivations that an investor may have to go into derivatives. You can either hedge, you can also speculate. That's taking a view on the market, what you believe it may happen. And you can also do arbitrage. We will take a look at each of these individually. And also you may change the nature of a liability or an asset, and we will take a detailed look at that when we cover swaps. So let's imagine that you have a wheat plantation. And if you take no hedging, no insurance, no derivatives, let's assume that in 6 months your crop will be ready, you will be harvesting your wheat, and of course that will be subject to an international price. Now let's assume that that price is higher than you expected. So of course that will make you happy because you own the wheat. And if the price happens to be low at time of the harvest, and if that price, for example, it's 80, that will make you sad. Of course, again, that's because you own the wheat and you took no hedging, no fixed position on the price. So you will be subject to the international price swings that happen in this case. Now let's assume that you do not want to be subject to that swing, to that price variation. So you hedge on day 0, you hedge the price at 100. So today you enter into a forward commitment and you fix your price in 100. Now 6 months later, let's assume that the price is 120. Of course, as we saw on the previous slide, that's good for you because you own the wheat. However, you fix the price at 100. So instead of receiving 120, you will receive 100. So in some sense, that makes you sad. So these cancel each other out and you end up with a neutral position. So your underlying gain in value, but your derivative contract pays you less because you fixed the price beforehand. On the other hand, let's assume that at expiration, the price of the wheat, the international price, it's 80. So that's not good for you because you own the wheat. However, you fix the price at 100. So you will receive more, you will receive above the international price. So that makes you happy, of course. So again, these two, in a way, they cancel each other out and you end up with a neutral emotional position. So a hedger wants to have a derivative that is opposite to the movement of the underlying. Let's take now the view of a speculator. In the case of a speculator, she has nothing to cover, nothing to hedge. So basically she's just betting on the future price of, let's use the same example of the wheat. Let's assume first that this speculator thinks that the price in the future will go down. Of course, that's just an expectation. It may happen or it may not happen, but this person fixes the price at 100. So if she thinks that the price will go down, but she does not have the wheat, she's just speculating, 2 things may happen. First, since you think that the prices will go down, you take a short position because at expiration, you will deliver the asset, in this case is wheat, and you will receive a payment. Now, this commodity, wheat, sugar, whatever, you don't have, so you will have to buy it when the contract expires. So let's assume that the price is 120, so that's against your belief that the price would go down. So in this case, you will deliver sugar or wheat or any commodity that is worth 120, but since you don't have that, you will have to buy it in the market. So you will have to buy at 120, deliver the asset, but you will only receive 100. So of course, this is not a good business because you lost 20 per contract. On the other hand, if actually the price went down as you expected, you will deliver an asset that is worth 80. Again, you may not have this asset because you're speculating. So you buy it in the market at 80, but someone will pay you 100. So you will gain 20 on that contract. So a speculator will be either sad or happy, depending on the outcome of the bet. And in this case, you're speculating that the price will go down. If you think that the price will go up, you again can speculate on that, but in this case you will take a long position. Again, wheat, sugar, whatever commodity in this example you are betting on, let's assume first that you are right, that the price did go up. So in this case, let's assume again that the price goes up to 120. So in this case, since you have a long position, you will receive this asset that is worth 120, but you will only pay 100 because that's the price you fix on day 0. So in this case, you will gain 20 per contract. And again, if you were right and the price went up, you will have a profit. Now, on the other hand, if the price went down instead of up, against your belief, you will have to receive that asset that is worth only $80, but you will have to pay 100. So of course, in this case, you will lose $20 per contract, and that of course is not good. So again, the speculator will either be happy or sad depending on the outcome, because he or she has nothing to cover. She's just speculating or betting on the price. Now let's take a look at arbitrage. Arbitrage is basically the equivalent of finding money on the street. Probably most of us have found money just lying on the street. It doesn't happen too often, but it happens once in a while. And it's a good analogy to arbitrage. So arbitrage is like making a profit with no investment. You're not using your own money, and you're not taking any risks. So basically the way arbitrage works is the investor observes something that is not normal, an abnormal or incorrect price, and he will take advantage of that on day 0. So the arbitrager will be locking in a profit on day 0. So an arbitrager can only be happy because he will lock in the profit on day 0. We will take a couple of examples in a moment. So basically the fundamentals to arbitrage is either buying low or selling high, or the opposite, selling high and eventually buying low. So in either case, you will lock in the profit on day 0 because you are watching something in the market that is not normal. It shouldn't be there. The same way that it shouldn't be money on the street, but even though that shouldn't be the case, once in a while it happens, and if it happens, someone will pick it up. So let's take on an example. Let's assume that you observe a future price of 102, and let's assume that the correct price should be 99.75. At this point, we are not analyzing how to get this correct price. We will do that eventually. But let's assume that you observe that the correct price should be 99.75, but for some reason, there is a forward contract trading at 102. So that's higher than it should be, right? So if that's the case, in a higher price, you will want to receive this money because it's higher than it should be when at contract expiration. So that means that you're going to take a short position because you will take that payment, you will receive that, and you will have to deliver an asset. In this example, let's call it asset A. So at time 0, again, the arbitrager observes this abnormal price. So he takes a short position. That will mean that at the expiration, he will receive $102 because the short position receives the payment. However, he will have to deliver asset A at contract expiration. So he better have it and he will buy it today. Let's assume that the price today is 95. So that's an outflow. You will have to pay 95 today to get that asset. So you're able to deliver it at expiration. And of course, money has time value. Let's assume that the risk-free rate is 5%, and you will have a contract of 1 year. So in this case, these $95 have an opportunity cost of 5% for 1 year. So that's $475 per year. So you will have an inflow of 102 and an outflow of 95 and 475. So the arbitrager is locking in a profit of 225 on day 0. Again, it's important to notice that this is being secured on day 0. Even though the money exchange will be done in the future, he can assure that he will have this profit on day 0. So that's why an arbitrager is always happy, because he is locking in a profit of something that is not correct. Again, this is secure on day 0. Now, let's take a look at the opposite or the other alternative, which is that the contract is trading lower than the correct price. Again, we will see eventually how this correct price is estimated. But at this time, let's just assume that it's lower than it should be. So if it's lower, you want to pay that because it's lower than it should be. So in this case, you will take a long position because you will pay this lower price and you will receive the asset. Now, on day 0, let's assume that you do not have this asset, so you can short it or sell it if you have it. So in this case, you will have a long position. What will happen at the expiration? You will have to pay 97. So you will pay 97 and you will receive the asset. So if you will receive the asset at the expiration, you can sell it today. So in this case, you have an inflow of 95, and those $95 you can put up to gain interest for a year. So in this case, you have a gain or an interest income of 475. So in this long position, you will have to pay 97. You will receive 95. You will receive 475. So on day 0, you are locking in a profit of 275. So again, the arbitrager is locking in a profit at day 0. So that can only make you happy. And that will be the case when you see the price lower that it should be on the market. So let's summarize the motivations for investors. In the case of a hedger, what she will want to do is fix the price, so the end result will be a neutral position. A hedger is usually not happy or sad. Basically, she's fixing a price, and the end result will be a neutral motivation or a emotion. The speculator is betting on the market movements, so depending on your ability of predicting future events, you may be either sad or happy, depending on if you got a profit or a loss. And finally, an arbitrager, it's someone that notices or observes an abnormal condition. So he or she will be locking in a profit on day 0. So the only possible outcome is that he or she is happy because you're obtaining a profit with no risk and no investments. So basically, we will start with a sentiment, an expectation, a belief, a preoccupation, and so on a underlying asset. That's a generic asset, an equity, a fixed income, security, and so on. We have a sentiment on that underlying asset that in the future its price may go up or may go down. So we either hedge, speculate, or do arbitrage using either of the derivatives, including forwards, futures, swaps, and options. And we will take accordingly either a long or a short position. And in swaps, we will talk about a fixed or a floating pair position. And we will be able to do that in private markets, over-the-counter markets, or in public exchanges. So thank you. That wraps up chapter 1, and we will meet you again shortly.